Hi, everyone. My name is Shohini Kundu, and I'm a fifth-year PhD candidate in finance at the University of Chicago Booth School of Business. I'm an empiricist working on questions in the fields of financial intermediation, corporate finance, and macroeconomics. Today, I'm presenting the externalities of fire sales, evidence from collateralized loan obligations. In this paper, I focus on the CLO market to show how covenants that are intrinsic to managerial contracts can generate fire sale risk with broad financial and real repercussions. In the aftermath of the great financial crisis of 2008, a number of financial reforms were implemented to reduce vulnerabilities in the financial system and enhance overall stability. Despite this aim, corporate debt markets have experienced burgeoning development. In general, the US experienced an increase of 41% in total corporate debt over a 10-year time horizon since the financial crisis. And of all corporate debt, leveraged loans constitute the subset of loans issued by riskier firms. This is a segment which has been growing over time, as you can see on the figure to the left. And along this line with new banking regulation, as banks have shifted from an originate to retain model to an originate to distribute, their direct exposures to credit and liquidity risks have declined. Liquidity and credit risks have been diversified to other investors, the largest group of which are CLOs. So CLOs have gained significance as a prominent source of credit to risky firms. When it comes to the purchase of leveraged loans, they're the biggest game in town. In 2019, CLOs purchased nearly 75% of all institutional leveraged loans that were syndicated and held over 25% of all outstanding leveraged loans in 2020. Why are CLOs interesting? Currently, CLOs pose one of the greatest risks to financial stability. The rise of the leveraged loan and CLO markets has attracted the attention of central banks and international bodies, which have been concerned with both the growth of the market as well as the opaque nature of interconnections between intermediaries, leveraged borrowers, and investors. These developments make the CLO market an interesting laboratory to study questions related to the transmission of shocks. There are two questions that I ask in this project. The first is, do contracts have externalities on asset prices that transmit to firms? And the second is, what is the mechanism through which firm distress can propagate to other firms? The empirical strategy is a Bartik-style difference in differences design in which I exploit the timing of the oil and gas price plunge and variation in the oil and gas exposure of non-oil and gas firms in the cross-section to study externalities. On the figure to the left, I'm showing the relation between a non-oil and gas firm's secondary loan price and its oil and gas exposure in the months surrounding the oil and gas price plunge. And in the figure to the right, I'm plotting the relation between a CLO's distance to the covenant threshold and a CLO's exposure to oil and gas. So you can see that there's a marked decline in the secondary loan price after the shock occurs. And you can also see that CLOs with greater exposure to oil and gas operate closer to their constraints after the shock. So what are the main findings of this paper? I find that firms with greater exposure to oil and gas experience greater incidence of fire sales in the secondary loan market. In market equilibrium, all forms of debt have to have equal risk-adjusted returns. Hence, debt prices decline across several debt instruments. In response, firm liquidity declines. Firms then experience reductions in debt growth, cash flow, investment, R&D growth, employment growth, sales, and acquisitions. And this is especially true for firms which are very dependent on banks as a source of external financing. That includes firms which had last refinanced before the shock, firms without access to the bond market, smaller firms, and younger firms. And these debilitating effects do eventually affect equity returns. So what is the mechanism through which this occurs? A CLO typically operates closest to its capital constraints. And the constraint is measured essentially as a ratio of assets to liabilities. It's a leverage ratio. The loans are marked for the most part to par, unless the loan has defaulted as a discount obligation or is in excess of its CCC limit. In these instances, the loan is accounted differently. So for defaulted loans, loans are marked to the lowest of the market value or recovery value. In the case of discount obligations, the loan is marked to the purchase price until the loan trades above a certain threshold for more than 30 days. And in the case of loans that are rated CCC in excess of a limit, all excess CCC loans are marked to the lowest market values among those CCC loans. So you can see that the CLO manager can mechanically alleviate the constraint by selling loans with the greatest difference between the market value and the accounted value. And it's precisely the riskier loans which are subject to these alternative piecewise accounting rules. Hence, fire sales are concentrated for this riskier subset of firms. So the main takeaway of this paper is that covenants provide a mechanism through which idiosyncratic shocks can amplify, and they constitute a source of systemic risk. Thank you.